what we do here. And there's a lot of things I want to kind of talk about that overlap professions a little bit. And then just I'm going to focus on some key things to really focus when you're starting uh, your financial career or it's just life in general. All right, make sure I share the right thing. Can you see my website in the background?
Yeah.
So one of these things on website, it's got outdated. I'm always going to keep on working on trying to upgrade it. But a couple of the key things I wanted, just our kind of our mission. We're committed to delivering a level of clarity and value that often surpasses what individuals experience after years with other firms. Our approach to holistic financial planning extends beyond the traditional model by integrating services across multiple disciplines. Rather than coordinating with 4 or 5 separate professionals, clients can rely on us to provide comprehensive investment and management with investments, insurance, taxes, financial planning, and estate planning, all within one single firm. This unified structure ensures that critical financial tax estate strategies are not only thoughtfully designed, but effectively implemented, minimizing the risk of oversight and maximizing long-term outcomes. So a lot of times what will typically happen is a lot of things will get overlooked. And what I mean by that is when we stress, if we don't work on somebody's whole picture and just part of it, we need to know everything else because some of the strategies we implement um, get missed. And it's these can be game changers too. Well, let's start with most of your W-2 employees. Let's start, working a job career, benefits. One of the things is I've noticed often, a lot of people don't realize everything maybe what their employer is offering. One of the main things I first ask somebody is, what's your number one asset? A pause. They're like, well, maybe my house, my car. Some will laugh and joke. I don't have any. But what it is your ability to produce income. So if you're a W-2 employee, I can't stress enough long-term disability insurance. See what your employer has they pay 100% or if it's a volunteer. If it's volunteer benefit and you don't pay for it, still probably more likely get it from your employer. It's going to be a lot cheaper than you look on an individual market. and and look at the contract too, and just make sure you understand what you got. Maybe it's a 60% of your income benefit. Is it a 5-year benefit, age 65, own occupation? Can you buy up a bigger benefit? But if you make, let's say 50,000 a year and you work for 30 years, that's 1.5 million. You insure your house, you insure your autos. Well, is that 1.5 million insured? So I can't stress that enough. Make sure you have long-term disability. And if you don't have it through your employer, even available, you can always potentially buy that in individual market. Another thing is, like probably most of you know, but I still come across this quite frequently. Take advantage of your employer in the 401k. Make sure you're maxing everything that you could potentially max, like free money. Some people ask me, well, I got the 401k or IRA. Do I do Roth or traditional? What's better? Some people say, well, a Roth's better. That doesn't necessarily mean that every case is different. You need to look at your taxable bracket. Maybe look at if you're married, potentially where your spouse's income, what your joint tax return is going to look like, what age you are at. If we all make financial mistakes, or if we maybe not a mistake, or if we just knew. So like if I were to go back and live again in my 20s, when I started my company, I would have took all my traditional IRA assets and put everything into the Roth. Why? Because I was showing no income that first or 1 year or two. That's one big thing I would have definitely did different. Also, flex spending account. Another thing your employer might offer, look at the health aspect or potentially dealing with childcare. Some people just don't know that they have it. A lot of times, if we're picking up a new household and family, I'm analyzing their HR benefits, the whole package to make sure they're always utilizing it. Health savings account. If you're in a higher deductible health plan, make sure you're utilizing an HSA. It's probably the best tax treatment that you'll see out there. You put an HSA, get the tax deduction, take it out for health related expense, pay no tax on that money. So if you're young, trying to save some money on health insurance premium, your employer might give you 3 options. Maybe go with HSA compatible and just keep putting money in that HSA. Maybe you don't need it right away, but maybe in 5 to 10 years. And then also on the HSA, a lot of times they're offered through that employer. If they are, just see what investment options you have in an HSA. So my rule of thumb is with HSA is about 10,000. So when you have about 10,000 maybe in your HSA, then you can start investing. If you have maybe 5 or 10, maybe using fixed income to grow it some, but don't invest it too aggressively because you might turn around and need it all in 1 year. And if we have a pullback like we're seeing right now, well, you just lost out a little bit. So, but yeah, that HSA, treat it like a Roth IRA if you can. So very often I see maybe people that are sitting, that are 40s and 50s and put HSA all this years, they may have 40 or 50,000, didn't have much claims. Well, if it's getting 0% interest, you're losing out right there. Then we have HSAs that won't. I'm going to try to keep focus on the age group, but we have HSAs. We have clients using, to reimburse themselves for Medicare premiums. Eventually, you're going to use this HSA money. Maybe along, down the road, or if you have kids, if you got kids at 0, 5 years old, they're all breaking an arm or leg, that money in the HSA can go up relatively pretty quick. There's also, most of you probably have 401k, but I mean, there's other retirement plans that you may have. Just make sure you understand your max limits that you can do contribution wise and stuff. Any question with employer benefits at all? All right. Another area is I can't focus enough, and this is for everyone. Live within your means. And starting at a young age, if you take that first job, let's say you're making, I gotta choose round numbers because it's kind of 50,000, maybe it's 30 or 40, but say it's just $50,000. And then you get a pay raise to 55. Well, maybe you spend a little bit more, but if you can just put that money aside, I just ChatGPT AI, I'm sure you all use it in your industry, use it, just did it real quick, $5 a day from age 21 to 61, $5 a day, 8% annualized return at age 62, that's $510,000. So next time you stop at Bigsby Coffee, think about it. Because I tell you, little bit like that can really, I grew up from where my background was, my parents could save. My mom could pinch a penny better than anybody I've ever met. And that's how I kind of got into the industry that I am. I became a saver in a very young age. I started putting a lot away. I was a cocktail waiter at Soaring Eagle Casino. And made really good money in college. And I had a financial advisor when I was about 20, 21. Started maxing Ross out at the time. Started day trading a little bit. I remember Scotch-Trade when it came out. Made myself a little here. Because we're like, what's Scotch-Trade? I haven't even heard of it. And the thing is, it got me a mindset. I enjoyed following it. Even if you don't enjoy it, if you can just get in the habit of putting in every month. And when you see times like you're seeing right now in the last couple weeks, just keep putting in compound growth. In my era, my time was I wish I had so much more money in 08 and 09. Because I could have put so much more to work. And you see the big drop, kept dollar cost averaging, things turned out great, but it's hard to stomach. And the biggest thing is emotion. People have a tendency to buy and sell at the wrong time. A lot of people, majority by far. So if you can get where you're in habit of putting it away, going in, rebalancing it, and reallocating it, your account, the risk tolerance that you're comfortable, not on an event like this, but just periodically when things are normal a little bit, which I think things today really are never normal. But you just got to take the fear, or you start getting a lot of gain in your account, or like, hey, I got a system up where I rebalance every year. You're like, oh, I'm gonna let it run a little longer. No, just take a little bit off of maybe like your aggressive growth stock that did well, rebalance into something else. Like Jim Cramer always says, I'm gonna go buy myself a cashmere sweater. It's the stupidest line, but it sticks with me. I watch a lot of Jim Cramer, by the way. It's one of the people I follow. He's pretty entertaining. Guy's 70 years old. He's got more energy than an 18-year-old. Pretty impressive. But that's one of the things is just save and put away. Give yourself opportunities. That's the biggest thing. If you got cash money, you have more opportunities. If you start spending at a very young age and accumulate debt stuff, you might not have quite as many opportunities. And then also when you're a young professional, protection. I'm a sports guy. Offense, defense, long-term disability, you're taking that out. If you got a young family, looking at term insurance, all right? Look at how much your employer maybe gives you, but also look at how much you need for income replacement. I'd say, I'm just going to throw a number, 90-some% are uninsured, young families are. And it's cheap. It's usually cheap insurance. It's easy to go in and push a button on your HR benefits to increase it, pay a little bit. You're probably overpaying. This is coming from a guy, we do a lot of group benefits. We're a lot of small business groups. And I'll tell you this, you can offer group life, that's great. But if you're healthy, go in and look at an individual policy for yourself for like 10, 20 years. For maybe you stagger, maybe one for $500,000 for one and $1 million. Term insurance is cheap. Lock in your health while you're young. Because trust me, things happen when you get older. It just lock it in, make sure you're properly insured, and keep revisiting it every so often. That's another big thing. Another big one is liability. I know you all hate paying home insurance, auto insurance. Michigan's pretty expensive. What I see is very often, and I'm very thorough when I do custom financial plans, is, hey, you got only 300 or 500,000 on your house. I at least carry maybe $1 million. Really? I'm like, yeah, and it costs maybe $5 more a year. It's not much. Make sure you got proper liability on your home or your autos. Maybe autos you're carrying 255. That's a real good one to probably typically carry, and maybe at least $500,000 on your house. And then where I also recommend to look at the price out is an umbrella. So an umbrella would probably run you $200 to $300 a year, $1 million umbrella. And the more you accumulate, the more you want to protect. But an umbrella would cover you just like what it is. It's overcovering your side-by-side, your house, your autos. If you hit someone, get sued, you got so much liability in the policy, and the umbrella will kick in. Hopefully you never have to come to this, because it's very always stressful when you're dealing with something like that. And it's cheap. Okay, one of the things is with parents with kids, I always look at this like, oh, you got your kid driving? Oh, driving your car, right? Your name on a car, right? What happens to your car? Your kid takes your car out and hits somebody. They're coming after you. So make sure that's where that liability insurance will kick in on your auto. With deductibles and so forth, not too concerned. Just, if you can afford it, higher deductible to offset maybe some of that liability coverage. And one of the biggest thing I've noticed, broad collision and standard collision. What's the two types? Broad collision is if you're not at fault, basically, or less than like 50% fault, you don't pay the deductible. So you can carry a very high deductible broad collision if you're a good defensive driver. And then you still might not have to pay deductible. I always carry broad. I always tell myself I'm an okay driver. I used to teach driver's ed, by the way. My career, 04 to 08, I taught and coached, and I was a driver ed instructor. So that's the big thing. Offense, when it comes to your offense, look at a lot of the things where are you tax-wise? If you're in the 12% tax bracket or 10 or less, you're probably doing Roth contributions. If you're anything higher, probably 22 or higher, you might be doing traditional. 30 and above, for sure, you're doing traditional. You're trying to lower your tax bracket. Most people that we deal with in Shiawassee County that are retired are usually 0 to 12. And you can be, multi-millionaire and be 0, 10%, 12% bracket for your pretty much your whole retirement life today in most cases. So if you're getting hit hard, try to lower your tax bracket. Another thing of being young, establish credit. Good credit. Good credit can save you a lot of money over time. Another thing is we do one of our arms is a mortgage operation too. If you do got a house, you got it set to escrow, kind of on cruise control. Make sure you know what your interest rate is, and continue to keep maybe checking it. And if you go to a bank or some other entity, they'll usually say you might have to be 1 percentage point lower to refi. It's not the case. Really look at the details of how much you're paying for it. Because back in 19, 20, 21, we were refining at no cost. What we were doing is for clients, we were taking like a credit they received and basically offsetting some of the costs. We were refining every 6 months for a period of time. Not now, but we did when they kept going down about 21 to about 22, and then the refi died out. But take advantage. 1% compound, a higher interest rate can make a huge difference in cash flow over time. And it's easy. I found some very high rates over the years. And now these people, the problem is, depending on where you're at, you got used to 2 to 3%. You go buy a new house out there, you're not getting 2 or 3. You're going to be getting 5 or 6, maybe 7, just depending on credit. And your purchasing power is not near as good. So if you do got that low interest rate on your house, be conscious on when you run the numbers with your principal and interest, and with your escrow, make sure it's in your affordability in that category too. Another thing is make sure we're not all good at what we do. Maybe profession, but like everything in life, make sure you get good professionals around you. No matter what. Like for me, I'm a finance guy. Insurance, I know well, but when it comes to construction or other areas, or I have other good relationships with other people that do what I do for a living, because we help feed each other and kind of bounce ideas and keep making ourselves better. So just get great people around you that can make a big difference. One of the things we stress in my company is we connect them with other professionals all the time. And just because people want someone that, like, hey, I've used this person, I've recommended him, I've had other clients that have used them, and making that call instead of calling 10 different people. A lot of people aren't going to call. They don't want to call through the internet or online. They'll just look up, 1 or 2 people will look up 1 or 2 people. They'll research that they were actually told about or recommended from somebody else. In today's world, rebates and tax credits. These will always change. Just make sure you know what's going on. Like cars for clunkers. Back in the day with 08 or 09, probably you guys don't even know what cars for clunkers are. But there's programs. So there's always programs. Maybe like for house improvements. There's tax breaks out there today. Make sure you're using a company that actually has the 4-digit code. I forgot what it was. I was talking to someone the other day, and they had a new electrical box put in, and they didn't have the right code for the tax credit. They were pissed. They were so upset. They lost out. It was like over $1,000, I think it was. So just these little things like that, and with the AI system today, you can be sitting in your office doing what you're doing right now. One of the things is I got my ChatGPT on auto. I'm just spitting stuff out all day long at it, because I'm like, gives me an idea or two while I'm actually working, multitasking, doing other things. And then that question, the response I get, I'm getting something else off of that I'm using for whatever, maybe a particular client. I use it in appointments specifically too, because it saves me time and I can get an answer, relatively pretty quick. Any questions? Does it feel, I got questions about anything? Hope lunch is good.
I guess.
But those are, I mean, there's a lot of things in our industry. Now, the biggest thing right now we're seeing another thing is estate planning.
Um,
Um, this is the biggest thing. So me, I was been a financial guy since '08. Started my own company in 10. I'm like, what are people needing? Back in 2010, we started a Medicare healthcare operation. People need to understand how this stuff works in and out, and this is changing. 14, we do a lot with the Obamacare. We write a ton of that insurance. A lot of agents got out. With the way the insurance is today, you could be a millionaire and qualify for like zero health insurance premium. People don't know that. You got to know how to strategize. You got to know how the taxes, the insurance, investment, how all these things go out around there. The thing we had in 19 was mortgages. The reason was we'd recommend people to refinance because I do very thorough custom plans, and people just get kosher. They're just okay with what they got. They don't know what it is. So we have things in all this that we're always continuing checking. The thing that we recently added is estate planning. AI's I'm in the lawyer field, there might be a lot of lawyers just gone in a couple of years. The reason is because of the AI systems coming in. And how is this going to take over? It's every industry is this way, right? I know like taxes and everything else. AI is always what role is it going to play? But estate planning, where I was going at with this, we work with Wealth.com that we're offering our clients to now, where it does a basic will, trust, power of attorneys. Make sure you got power of attorneys. I don't care if you're 20 years old, oh, I'm invincible. You never know something happens. Just have 2 or 3 people line up for health and finances. Just get it set up and revisit it every so often. Maybe you update it. Your will, trust, make sure you have something estate set up. One of the biggest things I look for red flags all day because there's a lot of things that can be missed that are a probate, go to probate, or be a mess. It can be easily avoided. One is your bank account. Look at your bank account. If you're curious, sometime today, go in your bank account. Do I have a TOD on it? What does that stand for? Transfer on death. Or also a beneficiary, they go POD. It's a lot. When you set up a lot of bank accounts, they don't a lot of times ask you this. Make sure somebody's on. Because question?
yes. Okay. Since we're talking about bank accounts right now, I do have a question before I
Yep.
lose my train of thought. How
Yep.
much should I be having in my emergency fund just in case something happens?
Good question. That's a good one. That's in my view, I'd say 10 to 20 typically. But the good thing is with emergency accounts today, you can still have it invested. So if you have it like in a higher yield money market, depending what
Hmm.
firm you're dealing with, um, that's all liquid. You can get it relatively pretty quick. So it's a preference thing. So like I always say 10 to 20, some maybe 30 if you're more very conservative. But like with our investments accounts today, we actually have check writing, debit card, ATM with our accounts.
Hmm.
So you have a lot more at your hand. And with emergency accounts, I mean, with all these programs you got, Venmo and everything, you can move money really fast today.
Yeah. And then also one more question. How would I put it? Refinancing loans, especially
Yep.
with vehicles right now. I bought a vehicle like 2 years ago and my interest rate on that vehicle is very, very high. So should I be refinancing it? Should I be getting a new
I
vehicle with a better payment?
look at it. Look at refinancing.
Okay.
And a lot of times the refinancing on the auto is like no cost, like
Yeah.
nothing. Not like a house.
Yeah.
House, you're going to have some expenses out there
Yeah.
in dealing with it. It's a very good question in dealing, but they came down a lot. They got high there. They got real high there 2 years ago,
I'm
two,
going to
three
be
years ago.
honest. I pay almost 10% on my
Yes.
vehicle.
Yes. I've seen that. Yeah. You could probably
It's
cut
a
that in
stake in the
half.
heart, but it's okay. I'm still surviving.
Right. Yeah. You probably make a couple calls. You'd probably be
Yeah.
amazed at how low you can get it. And
Yep.
maybe your credit's probably made a little bit better now too. So you got a lot going for you. Rates dropping, credit's better. You're looking at probably saving a lot.
Yep.
And then dealing with another thing is once you get old, a lot of people don't know you can do this with an investment account. Is a line of credit off your investment account, line of equity. So why I like these a lot, I have recommend these for clients. It's got to be non-IRA money. So once you've accumulated, you got your savings and checking, you got your retirement account, you're putting more money away, maybe to buy a house or just to have for whatever you want, maybe just for another retirement asset or just whatever comes along. So let's say if you have like 100,000 in an account, you want to do a line of credit, you could do it for 50,000. And they charge the rates. Most of the rates are about equivalent to 30-year mortgage rates. But why do I like them? The reason is the cost. You don't have loan fees. You go to buy a house. If you're only going to use it for, if you're going to use something like that to buy a house, that's a cash deal. So if you have enough in the line of credit, like you could take all of your thing and just say it's a cash deal, you could close in 2 weeks. You can use it as a leveraging tool to get a better deal than somebody maybe offering a government loan to buy a house. Probably a young professional, you're not there yet. But when you start getting there and accumulate, or you inherit money, okay, that's another thing. Let me tell you one of the main strategies is secure. There's two main ones that may focus on somebody here or maybe in the near future. Is one is the Secure Act and with inheriting an IRA. If you inherit an IRA, you have 10 years to spend it, unless it's your spouse. Then you can kind of absorb it as your own. What we have clients doing is I'm like, all right, Mr. and Mrs. Clients, take a look at your account. I want you to do this. I want you to maximize your 401k every year. They were only, let's say they put like 4,000 bucks in. Brett, you want me to do 20 some 5,000? Yeah. Where am I to get that money? I only make 50. What you're going to do is you're going to pull out the inherited IRA that you have to pay tax on. You're offsetting it with a 401k contribution. It's a wash. Okay. That's one way we've gotten, instead of, you used to be able to stretch it over your life. You can't. When people are inheriting this money now over that 10-year period, they're inheriting it at their highest earning years usually. So most of them are 50 and 40, but we got some clients that are 20 and 30 that might inherit this. Their parent might have died pretty young, was a single parent or something. This is a really strategy to use. Another thing is they're inheriting Roth IRAs today. And that's 10 years you got to take it out, but it's tax-free whenever. But you could be taking that money and putting it in your Roth IRA if you wanted, or maybe your Roth 401k. So that's one of the main strategies we've implemented for a lot of younger professionals that inherit money. That's retirement. Another thing is if you have any 529s out there, okay? If you had a 529, you're like, luckily you had scholarship money, you didn't use it all. The 529 after a certain period of time can be converted into a Roth IRA up to 35,000. So if you got a 529, it's a beneficiary. I mean, you can always change the beneficiary and leave it to another kid or grandkid or whatever. But if it's meant for you, just go in there and you can convert it to a Roth IRA. This is, again, one of the little newer things that's just in the last about year or two that's out there. And some of the investment firms don't even have the right paperwork kind of that geared up for it yet. Is one of the things we notice. And another thing is with 529s, UTMA accounts, you got the Trump accounts coming out if you're looking at for new kids. There's a lot of options out there. We do a lot with 529s and UTMAs. It's just a preference thing. If you want more flexibility, you're using a UTMA, which is a Transfer of Minor Act. So when the kid's 18, the money will become their asset. The 529, it's educational usage, but it can be, it doesn't have to be like a 4-year school. It can be a skilled trade. It can be used for other programs. And here's a red thing I tell you what a lot of people mess up on. Make sure if you're taking money, if you're in school, you're taking money out of a 529, you have that expense in that year. A lot of people will go into January like, I want to reimburse themselves back for last year. No. Do it in the same calendar year. That is a big one where I see. I bore everybody too much yet?
Well, that's why I was asking questions.
I mean, I'm just thinking areas. That's like I could put a present, but a lot of this I just tell you from if you're 20s to 40, that range. There's things these are things to consider. Next is parents. Who's the power of attorney? On your parents. Do they even have stuff set up? Ask your parents. We picked up, I remember in July, August last year, I picked up 7 new households, no estates in order, and they were all 50 to 75 years old. Nothing. Who's going to deal with that mess? You guys. Make sure their ducks are in a row. It's not, parents have a tendency to procrastinate a lot. And usually it's a big life event that triggers them to get motivated with it. But I just see this, I just see too much. You having a conversation with their parents a little bit could go a long way. Just to guide them a little bit. And it's, it's sometimes not the cheapest, but it depends on the case. If it's a simple two retirees that are just W2 employees, just taking IRA distributions, retirement, it is simple. All right. It's very simple. You just got to look at all the assets. I go through the transition period with a lot of households because of what I do for a living. And you might have a good relationship with your brothers and sisters, but just because something was done incorrectly with the estate, now you got some feuding that could have been easily prevented if spent just a little bit of time to getting ducks in a row. And it's worth conversation. There's a lot of planning strategies. I always tell people I'm an artist in what I do, but I'm a horrible artist. Like, what do you mean by that? There's a lot of ways to be very creative in what we do. You just got to know who to talk to and how all these parts move. And if you guys have questions, whenever, feel free to pick myself or my firm's brain on things.
I do see there's a question in the chat. It's saying, is paying your mortgage biweekly a better option than paying monthly?
Yes. Yes. Saving interest. Check with your lender to see if they're going to charge you extra. Yeah. Usually you're just sitting in a bank account, right? You're just sitting in a bank account anyway, not getting any interest. So I love the idea. Or you can be my mom when I was a kid. She'd leave her lunch hour and go to the bank and put a down payment like weekly. But interest rates were like 12 to 15% in the mid 80s. So it's a little bit different story. Great question. For some reason, I didn't see that on my chat side, but
it's okay.
I'm just trying to think, what other big things? The biggest thing, though, is I can't stress enough, is just live within your means at a young age. Learn to live without a little bit here and there, and just increase your lifestyle up. It just gives you so much more opportunities. And it just, people are like, oh, I'll start investing tomorrow. Well, you're a day late. Nobody ever complained investing too early. Nobody that I know of, unless you just time something really wrong. Let me try to see what else I got here. Main things. A lot of good resources out there. Being a young professional today, you can learn a lot quicker in finance on your own than you could ever with all what's available to you. You're still going to get other people's opinion. Like, a lot of people bring up Dave Ramsey, and like Dave Ramsey, you get 80% of the people, 80% of things he says do. 20 question. The reason that is, his audience is everybody, right? Everybody's situation is different, totally. You got student debt, do you inherit money? Everyone's different. So he's got some great concepts, but there's a lot of out there. What I typically do is I'm customizing. I'm listening, questions. My head's just turning, looking for some ideas and strategies when we talk to people. And sometimes it might be one or two simple things. Sometimes when I get a new bit, like a business owner coming in, that's where I'm like, there's a million things we could be doing. I don't know anything about, I have a 401k. I'm having a problem seeing the whole question. Okay, got it. What would be great? I don't know anything about investing. I have a 401k through work. I let them manage it. What would be great? See what options you got. Go in. A lot of times is you're probably in a target date fund. Target date funds are a great way to start in a 401k at the very beginning, and then see what's available on your platform out there. Research the ticker a little bit, and then just kind of look at, hey, how much is your cost? What's your top 10 holdings? Morningstar is a great program. I use Market Watch, which is free program. Morningstar, different level. I spent a lot of money on some of the Morningstar programs too. You can spend a lot on technology today. Watch CNBC. Just maybe listen to a couple of people talk. Just pick up some things off of there, like something they say, like just follow. I don't use one thing. I use tons of programs and that. I come and educate, and I self-taught myself. People are like, how do you learn everything? I self-taught myself everything. Asking people right questions, just having a passion and enjoy what I do. But sometimes when your 401k sites, you get in your 401k site, you might actually have information in there that might give you a little bit of details too. But take a look also vesting. Another thing I mentioned, your vesting schedule on your 401k. See if you got a vesting schedule. Maybe it's a safe harbor. Maybe you're 100%. You're vested. What does that mean? Is if you might have some money invested in the 401k, but you don't have 100% ownership yet. So most accounts are 100% right at the beginning, but you might only have a certain percentage you actually own up until 5 or 6 years that you're actually there. Or just start talking to AI, just start asking questions. That became one of my new best friends.
I do agree on that one. I use it for everything.
Double check ChatGPT sometimes though. When the new truck tax bill came in, I was trying to run some scenarios with like the deductions with some of the enhancements. It didn't have it in the system yet. This is months after it was passed. So kind of question some things sometimes.
Yeah. So not to turn financial into AI, but we use a secure platform through SDP. We actually pay through it. It's through ATS, or our IT company. Yep. And we use it obviously for RFPs, certain documents that we're running through, obviously stuff that I don't want to, leak out. So there are multiple options that we use: Claude, Gemini, ChatGPT, all of the other languages you want to call them. But I hear that from a lot of people that, you have to double check it sometimes, even though we're, I can remember when it first came out when I was in college, and all my professors were like, oh my gosh, this is a new thing, everybody use it. And now everybody's using it, but it's still, not catching up to times, which, I mean, not everybody should be using it, especially the grandmas on Facebook. Making some pictures and putting them as their profile pictures.
Well, that's another thing is, if you all probably have some grandparents out there, maybe just making sure they're not doing stupid things where they're, identity theft.
Right.
It happens a lot. They hit the wrong button on their phone. Now their phone's hacked, or they're just doing stupid things. They just don't know. Mm-hmm. Out there. There's also another thing is it could help simplify. One more thing I think of here is there's a lot of programs out there where you can see all your information in one site. And like the one we use is Right Capital. It's secure and stuff, but you can't see accounts. It's a way for you can see your bank accounts, your retirement accounts, your insurance contracts that maybe input, your loan, everything. You can input by hand, but it gets the feeds. So if you have like Fidelity, put Fidelity in. And it's an advisor platform, but there's free versions out there too. And it just allows you, when you have so many moving parts, allows you to see everything on one screen, kind of see, hey, what's my net worth? How much did I got again on that? Just like it's a quick reference. So that kind of can help you if you got a variety of stuff moving. And the older you get, the time goes on, your financial picture will probably get more complex a little bit here and there. Any questions about investments, anything, planning?
Okay, so since nobody wants to ask a question, when I haven't bought my first house yet. I've
Yep.
rented, I moved back home after college. When would I be financially ready as a young person to buy a house?
Well, the question is, do you plan to stay where the location? Do you plan to
Oh,
stay there a
yeah.
while?
Yeah, I will not. I lived the last 25 years in Byron. I love the area. I commute back and forth. Obviously it's only a half hour, but I would love to be in this area. I'm not leaving Shiawassee whatsoever.
Okay. I mean, there's a lot. Shiawassee has a lot of programs. So you got, USDA program potentially. FHA. There's some other types of ones out there too that you may want to consider. Or if you can just do the typical conventional loan, you don't
Mhm.
necessarily need 20% down. You could do less and just compare them. Um, House pricing market. Another thing that I did was I bought at the peak, but just because of the timing, I bought in '05 and the things took a fan. I actually sold my house for less than when I bought. It was just the timing of it. But what I did do is I sold a land contract. It sold it for 30% more than the real estate agent was enlisted for. And so I just being creative in that way. But the thing is, it just depends. If you're going to be there a while, rates are pretty good right now. They're hit their averages, let's say historic wise. They're not going to get the 2, 3, and you might get 4 again. So
Mhm.
and the thing is just accumulate. Another thing is if you're doing some retirement and you don't know if you want to earmark for home or retirement, you can put in a Roth IRA and take up to 10,000 out of that Roth for a down payment too. In Shiawassee County, we've done all those loan types. So USDA, which you have to put nothing down. It's just you have government costs built into it.
Right.
Um, and just look at the market. If you think you can run projections of your insurance cost. Here's go to Michigan.gov website, do projections of what the house taxes will be. So there's a program, if you bought it for, let's say you bought it for 200, the SDV is going to be 100,000. It'll tell you go in there what township, exactly how much, what it would be. I've seen people, I had a client, we just did a cabin up in north. We do everything, investment insurance, all that. And she went to someone else, and I was like, no. I goes, your taxes are going to be like 8 to 9 grand, not 4 or 5. Like, what do you mean? It's because this is the second home. Oh, they were just quoting out as the first home, your primary. So make sure that's a big difference, right? So make sure when you're in there, you just look at, can I afford this? Because once you do that fixed loan, at least that's the worst case scenario. You're gonna be locked in it. So if you can afford that and cash flow is fine, maybe you can rent out a room. I rent out 2 rooms when I bought my first house. The 2 other teachers. It paid for my mortgage. So I mean, there's things you could do. There might be some government programs that come out to encourage too. There has been over the last couple of decades. So maybe there eventually you'll see a program or two that comes out, or they change some of these programs. It's hard to keep up with them all the time.
Mhm. Yeah,
That
I feel
goes.
like everything is changing in our world. I'll go out to an investor with us and be like, actually, so that grant application is on hold right now, so can't tell you about that.
Right. Yeah. No, when they change. Oh, one other thing to do, I don't think SCDP for help me on this is with the land bank. When you buy commercial property, do a very thorough detail inspection. I did an inspection, didn't do very thorough, and kind of bite me in the butt. And SCDP came out and helped with the land bank on that building. So that's one bonehead thing I probably did do. But
Um,
I look at it. It actually, it's one of those things we use it for marketing for quite a few years, 6 years, branding. When we came to conclusion, when industries change, I bought my building in 19, COVID hit, right? I work remote 3, 4 months a year out of Fort Lauderdale. And it's just my team's in Michigan based with technology and everything. We don't need storefront anymore. Ours is word of mouth business anyway, referral business. If you got internet connection and enjoy live where you enjoy is one of the things. And you can do that today. Your parents couldn't. They had to go where the work is. So with technology, we may have the capability to work remote, do some other things a little bit different. I think that helps Shiawassee County. Lower house pricing and nice area community, pretty calm area. You come here, work here, maybe companies based out of a different city, and get paid a little bit higher that way.
I do see there's one more.
Okay, shoot away, 'cause I can't. I'm having problems seeing.
No, you're good. I'll read it out loud. Do you do much with VA loans?
Yes. Yeah. Yeah. We haven't done it. We did a ton back when we had a lot of the refis, because it's the easiest refi loan in the world. VA Streamlines. VA loans pretty easy, not too complex. They can be picky a little bit when you go to buy a house. Have an idea going in. This is one thing with a VA, FHA, and government programs over conventional. Just look at details on a house, because VA and FHA might be picky on certain problems with the house, and those might need to be corrected before you can actually buy the place or move in, kind of. So we do some VA loans, but that's another thing. A lot of people don't. Your real estate agents are usually pretty good at finding those things, but I just want to make you aware of it. All right.
right.
I got somebody else typing. Oh, you're welcome. I hit the little box. Yeah. Also, VA loans. You know, you got like one where you get the biggest bang for your dollar. If you think you're going to be buying another house, you may not want to use that on one particular home. Like I had a conversation in my office Friday with, I have a kid's younger, around 20, and his dad was in, and he's looking to move out west eventually, Wyoming, Montana. And that's what we had a conversation. He might save that to when he spends a little bit more on a house. I had a good friend that did that too. It uses VA to about upper 30s. That was probably about the fourth house he bought. Getting about running out of time.
Yeah. Oh, he's typing again. I'll slowly play the Jeopardy theme song real quick.
He types like I do.
You can only use the VA loan X amount of times. Still typing.
Yeah, I can't remember exactly. I just know there's a different, we had like the first one or the second one. It's a little bit different.
That's a question. Sorry, I've used it twice so far.
Okay. With it though, Keegan, with that, there's something a little bit different with the VA loan. I can't remember that if the first usage and the other usage it's a little bit different on something. You might know it off the top of your head. I don't. Without researching it real quick. There is some limitations though. It's just treated different. I can't remember what it is. I just had a case that we looked at a couple years ago. I still typing on it. He probably knows. So
typing again.
Yeah, I mean if he did it, he probably knows exactly. I did some VA loans at 2%. It was 1.75 refi. Back at the prime time. You're never going to see that again.
Okay, no worries. I'm thinking about moving is all. Ha ha ha. Thank you.
All right, like I said, feel free to give us a shout anytime out there. Like I said, the thing is, use a lot of the resources that are available to you. Live way within your means if you can at a young age. Take advantage of everything the employer gives you benefit-wise, because I see a lot of hanging fruit just out there. And get good professionals around you that can help you too. Because I mean, that's just some of these little decisions can make sometimes a big difference. And you don't want to learn, if you can prevent from learning the hard way, because you learn the hard way, you learn, but hopefully you don't. Sometimes it can be very costly.
Well, thank you, Brent, so much. Thank you for everybody joining today. This webinar was recorded, so it'll be sent out after this. Just a little update. We do have trivia on the 13th of next month at Barristers. There is an email link that has been sent out to everybody. Starts at 6:30. Food's covered. So come out and enjoy some brews and bites and some fun at Barristers Brewing over here in Owasso. So thank you again for joining today, and hopefully everybody gets out and either goes golfing later, because that's what I'm going to be doing after work.
Nice. Good. Enjoy.
All right. Thank you, everybody.
Yep.
Bye-bye.
Thank you. Bye.